More gum, more gum.
Are you Wonka here? Where's the Oompa Loompas coming out?
From Billy
More
Madison?
gum, more gum.
I
From
Oh,
Billy
yeah.
Madison? Do
guess
you
I haven't
have
seen-
any more gum? More gum, more gum.
I guess I
Come
haven't
on.
seen Billy Madison.
So good.
AJ and I are closer in age, so we're gonna get all the Adam Sandler references.
Right. I love all of them. I used to watch those like crazy.
Oh, it was great.
Who's Adam Sandler?
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 7 of Drunk Real Estate. I am Kyle Wilson, joined with my jovial co-hosts. Starting off with Mr. Jay Scott. How's it going, Jay?
I am jovial. Thanks for asking.
Perfect. What are you drinking tonight?
I am drinking another cab, a Papillon by Orin Swift. And I guess I have to thank my good buddy, Nathan Brooks, who sent me this bottle a couple months ago. So, Nathan, thanks for
Shout out to Nathan.
Yep. Thanks for the wine.
That's an intense looking bottle.
Hey Nathan, I like wine too. I didn't see anything anywhere in my mailbox.
Might as well get something out of this, eh? Solicit gifts. Next up, after Jovial Jay, we got Mauricio. How's it going?
Ooh, it's going good, man. I'm offended though. I'm a little offended. I've been working hard on my new background and nobody's made a comment about it.
Wow, that is gorgeous, man.
Love it.
It's a work in progress, but it's a major change and nobody said anything. I'm offended. I'm hurt. I'm not sure I can do the show.
Is that a hint of the leaf over your corner there? A little greenery?
Yeah, a little fake. It's to make sure you don't see the lack of black over there.
Dude, my wife will change the furniture in my house and I won't notice.
I am drinking, Kyle. I know you want to know what I'm drinking.
Yep.
And there were some comments about, I think there were negative comments about us drinking white wine. So I decided to bust out a white wine. So I'm drinking a 2021 Rambauer Carneros Chardonnay. So for all those people who don't like white wine, sorry.
Is that like a thing? As the non-drinker of the group, is like white wine supposed to be inferior? Oh.
No. It's not necessarily inferior. It's just you typically are one or the other camp.
Ah, got it.
It's kind of like drinking a wine spritzer.
No, it's not.
I'm all inclusive. I'm all inclusive. I like them all. I don't discriminate.
All right, AJ, what do you got for us tonight?
All right. Well, everybody's favorite designated driver is drinking the Monster
Is that the Ultra?
Zero Ultra.
Oh, that's our go-to. We love that. 10 calories. There you go.
That's right. It's got 250 grams of caffeine.
How much aspartame does that thing have?
Enough to mummify me, probably.
You want to join your dinosaur fossils?
That's right. I'm very well preserved. I'm going to last as long as them.
Yeah, I can't believe you don't have one in the background. In like every other room in that office of yours, you have a fossil somewhere.
I know. I do need to bring Ernie in here.
Well, he's got so many, he's got to name them.
Kyle, what are you drinking?
I followed up Jay, and I went with a little bit. Can you read that?
Clear rum.
A little bit of clear rum, but I'm going on the rocks instead of those ready to drinks. I'm just going straight up because it's just so good. You could just drink it straight on the rocks.
Wow, very manly.
Yeah. Did you know that clear rum has 0 grams of sugar and 0 carbohydrates?
Did you know that Kyle's an investor in clear rum?
It's 12 times distilled and 18 times filtered.
Are we already plugging stuff?
No, we can move along because there's been a lot of talk right now about the Fed meeting coming up next week. But little do we know that interest rates don't only affect real estate investors and banks. There's actually businesses and corporations rely on debt. Who would have thought? Quite a few large businesses are showing a bit of financial distress. So, Jay, could this be the catalyst for our recession that we've been calling for?
Yeah, I've actually been talking about this for a couple months now, that whenever people say, like, what's that thing that's going to break, that's going to cause us to head into recession? And obviously nobody knows for certain. But if I had to guess, what I've been saying for a couple months now is I think it's going to be businesses. I think we're going to see businesses start to struggle. It's going to lead them to start cutting, laying off people. cutting hours, leading to unemployment, which is going to lead to a recession. Now, why would this happen? Because it looks like job numbers have been strong the last year, 2 years, and that's true. Job numbers have been pretty strong. There's no reason right now to think that there's any major cracks in employment or businesses. But one of the things that I'm starting to read a whole lot more about, and I'm starting to see personally, is the fact that the increase in interest rates is also starting to impact businesses. Think about it this way. When you increase interest rates, that's going to increase borrowing rates. Just a couple years ago, businesses, and just to give some background, about a third of businesses still use traditional financing like loans. They go to the banks or they go to SBA and they borrow money. A couple years ago, they could go to the SBA and borrow money at 4.5%, go to a bank and borrow at 5 or 5.5%. These days, if they go to the SBA, they're paying 6.5 or 7%. If they go to banks, they're paying 7 or 8%. So their interest costs every month to borrow is a lot higher than it was. And a lot of these small businesses, they can't afford to pay extra money in interest every month. And so
Well, even the large businesses put out bonds too that are even higher than that.
exactly, companies like Walmart, companies like McDonald's and Lowe's are
Live on debt, short-term debt.
yeah, they're issuing billions of dollars in bonds that a couple years ago, they were paying bondholders 6, 7, 8%. Now they're paying 10, 11, 12%. And so it's basically businesses across the board are getting hit hard thanks to increased interest rates. And so the logical question is, how is this going to impact businesses as money starts to run out, as they need to continue to borrow, but have to borrow at higher rates? I personally think, and the data is starting to show this, that we're going to start to see businesses struggling and that we're going to start to see some layoffs. If you look in the first half of 2023, Chapter 11 bankruptcy filings jumped 68% over last year. So we're already starting to see it. And then you have
aren't we already, Jay, to like 2012? Like we're back to like 2012, 13 highs for filings or something I was reading the other day?
Yeah, we did see a big drop in 2017, 18, 19, and then we saw a huge drop because we were giving away free money during 2020 and 2021. But yeah, we're getting close to what we were seeing back in like the mid-teens, 2015, 2016 numbers. But the scary part is that the trend is moving up quickly. We've gone from very few bankruptcy filings to a big increase just over the last 6 to 12 months. And so the concern is that trend, that increase in pace of bankruptcies is going to continue to increase. The other thing a lot of people don't think about is that over 20% of all small businesses are mostly tech businesses that are backed by venture capitalists. So venture capitalists backed business. 20% of GDP. So a fifth of the total money that's generated in our economy is coming from these venture-backed businesses. And for anybody that's been paying attention to the tech sector or venture capital, what we've seen over the last 12 to 18 months is that essentially venture capitalists have stopped investing. And so we have literally tens of thousands of tech businesses, small tech businesses that for the most part, they get an investment. That investment is 1 to 2 years. After that 1 to 2 years, they go back to venture capitalists or angel investors and say, we need more money. And venture capitalists are no longer investing. And so a lot of these small tech businesses are going to run out of money and they're not going to be able to get new investment, and they're going to start laying off or they're going to go out of business. So basically, regardless of whether businesses are getting bank financing or traditional financing, whether they're issuing bonds, whether they're getting venture capital, all these businesses are getting hit hard. And my thesis is that over the next 6 to 12 months, we're going to start to see businesses struggling, and that's going to impact employment.
We lost Kyle there for a second.
Let's just wait for someone to chime in. Yeah, so it's I don't know. Anyone got a comment on that?
Well, let me jump in here because this is something. I totally agree with Jay. This is something I've been following even before the interest rates started going up. I always followed the amount of what we call zombie companies in the S&P 500 or even the Russell 2000, which are a little bit obviously larger companies than the mom and pops. But even by the Fed's own analysis, they did a study and showed that 10% of the S&P are unprofitable, or what they call actually zombie companies, meaning if it wasn't for the amount of debt they were able to, acquire at really low interest rates, they wouldn't exist. Goldman Sachs puts that number at 12. And, the stuff that I follow puts that number even higher. And if you look at the Russell 2000, which is the highest 2000 company, that's close to 40%. 40% of the Russell 2000 companies are actually unprofitable. And a lot of them have been staying afloat based on these really, really cheap interest rates, meaning they're unprofitable. They don't have any money. How do they plug that hole? They get a loan, whether it's from venture capital, like Jay was saying, whether it's a bank, whether it's a private market. They're able to tap into those markets because interest rates were 2%, 3%, 4%, 5%. But obviously, with the interest rates skyrocketing, it's going to be harder and harder for them to raise that capital. And so when those loans become due, it's going to be very difficult for them to refinance. And I think that Jay's right. That's going to be another one of the several catalysts that could lead to the next recession. I still think it's going to be a credit crunch based on these high interest rates, and we're already starting to see that. And I still think this is going to happen by the second half of this year.
So we just waiting for these companies to basically refi is what we're saying. So like they're going to have some of this debt come due, or
I think they'll issue debt and not get it.
right.
So they're going to go out to try to get reasonable debt at reasonable rates, and it just won't work. They can't afford it. So then they just don't have it.
So they lay people off.
Well, because I know that with these bonds, with the corporate bonds that we brought up before, so like they're different grading, right? So of course you're going to have your U.S. government bonds that are like the highest grade, AAA, and then you have some, your, as you pointed out, Coca-Cola, Walmart, Apple. They do their A grade bonds too, where they're just a little bit below what those AAAs are, but you still have that kind of long-standing track record, and then it kind of works its way down. And I saw a thing where it was like the concern is someone like who has like a triple B rating who went out and got their debt issued a couple of years ago, and that debt's coming due, and they have to refinance those triple B bonds. Well, all of a sudden, because of the interest rates pushing up, that their debt service is going to push them to a lower rating, so they're no longer triple B, and that's just going to start a cascade effect where they not only have to pay a higher rate because of the interest rate increases, they also have to pay a higher rate because their rating's going down. And we're just going to see it domino from there, that all of these different companies are going to have.
Yeah, but Kyle, even the AAA company, I mean, I still remember, companies like Tesla and Apple, why would they, use their earnings? They could they go out to the market and issue bonds. They were issuing bonds at 2%, 2.5%. And these were like Tesla. I mean, these are AAA companies. So just imagine what these lesser companies are doing. And I think Jay's right. I think the higher interest rate's really going to cause issues. And when you don't have any money, there's only one thing you can do is you start cutting costs, and that means you're cutting labor.
A lot of that money went to hiring people, right? Like it was easy to hire somebody when you basically got the money for free. They just had to cover their expense. Now you're going to have to be a little bit more careful with your hiring. You're going to make sure, okay, I want those 2x people who are going to be twice as profitable as their salary, instead of just hire as many people as you can, and it's okay because it's cheap.
Well, and the government's trying to do this. This is the point of it. They want people laid off. I mean, a huge part of the artificially high employment we have was that how many businesses took out PPP loans predicated on keeping employees, and they bridged a gap with that. And we still have a lot of employment from a lot of that was pumped up, that was kept, that was, even when some of these companies were contracting, they kept them on. I mean, the employment is so weird right now because it is stuck in this level where we have certain employment numbers where you can't get people to work. So we have certain jobs that restaurant jobs, service jobs, people won't even do them. And then you have whole other layers in these huge tech companies and things where they're laying off at mass, and it's not even going to affect output. So it's like there's a big change in the labor markets, I feel. And I feel interest rates should be putting more pressure on that and this cycle as we go through to reshuffle around a lot of this workforce.
Yeah, and I think it will. And I think we do see a lag effect when it comes to rates and businesses, simply because businesses don't borrow money every day. Typically, they've got a year or 2 or 3 lead time after they borrow or after they take investment before they have to go back to the well and get more money. And so the question is, at what point is that going to start to kick in? I mean, it's been 12, 18 months now since the COVID money has sort of run out, the PPP money and the EIDL money. And so businesses are at some point soon going to either need to refinance their debt or issue more debt or get new investment. And so at some point, I have a feeling that we're going to wake up one day and we're just going to see that like it's all starting to hit at once. Now, when that is, I don't know, but I suspect it's within the next year.
Yeah, and don't forget, it's no different from the commercial real estate, which is in the world we're at. I mean, they're at the end of the day, they're also businesses, right? If you're a syndicator and you're raising money for, and you run businesses in the multifamily space or self-storage or mobile home park or whatever, you're running a business. And this has been impacting our industry for the last 6 to 12 years, and it's going to continue to impact. And at some point, there's a tipping point where kind of it tips over, but it's happening all over as we speak. And it's just gradual. I mean, it's been happening. It's going to continue to happen. And at some point, that tipping point is going to hit, and you're going to hear about it.
Well, here's something interesting. And so we've been talking about the short-term issue of interest rates hitting businesses and leading to recession. But I was reading, and I think, Mauricio, you may have sent me this or mentioned this last week. I was reading a paper called End of an Era, the Coming Long-Run Slowdown in Corporate Profit Growth and Stock Returns. It's written by a guy named Michael Smolansky. He's a senior Fed economist. And basically what this paper was, it basically, the thesis of the paper was that low interest rates and low corporate taxes over the past 30 years or so has directly accounted for the majority of the tremendous stock market gains over this time. So basically, specifically, he said that between 1989 and 2019, low interest rates accounted for 40% of real profit growth in U.S. companies. In other words, if interest rates had been their historical average between 1989 and 2019 and not lower than the historical average, what we would have seen is 40% lower profit growth, real profit growth from U.S. companies. Now, imagine if U.S. companies across the board saw 40% lower profit growth over the last 30 or 40 years. What would that have done to the stock market? Likely, we would have seen a stock market that was much more subdued, much more stagnant, didn't see the growth we've seen. And so the conclusion that this Fed economist came to, is that over the next several years, we're likely going to see, thanks to higher interest rates than what we've seen, higher corporate tax rates as well. What we're likely to see is a stagnating stock market, and a stock market that really has trouble growing, because we're going to have a lot of businesses that aren't growing the way they have for the last, again, 30 or 40 years. Now, my question is, obviously, that's going to be bad for the stock market. It's going to be bad for stock market investors. It's going to be bad for a lot of us who have money in our retirement funds, our 401ks. But if the stock market starts to stagnate, there's a lot of investors out there that are going to have to look for alternatives. What are those alternatives going to be? I suspect a lot of them are going to turn to real estate. And so it might be bad for the economy. It might be bad for the mom and pop investor. It might be bad for the retirees who are relying on their retirement funds. But it could be really good for real estate operators who see a whole lot of money flowing from the capital markets and the stock markets into real estate.
Or it's going to crypto and Ripple, right?
That's possible as well.
Well, but I guess I don't understand though why. So once we're in a higher rate market than we were before right now, but the expectation is those rates are going to come back down at some point. And we're also going to probably do some more quantitative easing at some point. That's kind of like the new playbook for when things go wrong. We drop rates and we start printing money. So once we go back to that side of the cycle, aren't we just going to be back to, full steam ahead?
So it was a very long paper, and I read it in as much detail as I could. And what I took from it was that the author surmised that a lot of businesses over the last few decades have been restructuring to run their businesses in a tremendously low interest rate environment, a tremendously low corporate tax rate environment. They've been using money to buy out competitors, to consolidate, and it's unlikely that we're going to see interest rates where they've been for the last 2, 3, 4, 10 years over the next 10 or 20 years, that we're likely to get back to that average interest rate environment, or at least somewhere in the 5-6% federal funds rate, as opposed to the 0.1-2% rate that we've seen for the last several years.
I guess I just disagree with that assumption, just because it seems like that's the new, as I said, the new playbook for what the Fed does is we can't have recessions anymore. We see like a recession happening, and the Fed has to step in and they have to fix it. Whereas it used to kind of be a natural thing, and now that we've kind of, given a little red meat of we can print money and all hell doesn't break loose, then they're kind of just going to do that too. So I just see that, we have this saying that's going around right now, like in the real estate space and commercial real estate, about like survive to 25. And I've heard it outside of the real estate space too. And I feel like these businesses and these apartment owners and probably in other spaces too are just saying this is kind of a temporary thing. We got to hold on for a couple years, adjust our business so that we can survive for a couple years, extend some of these loans, and everything's going to be back to normal. Whether or not that's true, I don't know, but that seems like the consensus of what everyone is structuring around.
Yeah, but what I'm hearing that survive to 25 as well, and definitely hearing it in the business and the tech world. A lot of venture capitalists are basically using that to kind of tell their businesses, hey, figure out how to cut costs, how to lower your run rate so that you can survive until a year and a half from now, with the thought that one of two things is going to happen. Obviously, the good thing, or I don't know if it's good, but obviously the thing that everybody's thinking about is we're going to hit a recession and interest rates are going to drop, which is going to be good for businesses. But the other thought is, even if we don't hit a recession and even if interest rates don't drop, at some point in the next year, 2 years, investors are going to recognize that maybe this is the new normal, and they're going to say, okay, I'm going to start investing again, even if we haven't seen that softening in the market, even if we haven't seen lower interest rates. They're going to want to get their money working again. They're going to want to take it off the sidelines. And in the venture capital world, we're talking, I think there's like 300 billion in dry powder right now. At some point, investors are going to be desperate to just start investing again, even if we haven't seen a recession or interest rate drops.
Money managers don't get paid by having cash sitting in a bank account.
It's true.
That works for a little while, but if it goes too long, people want their money back.
Exactly.
Because they want it working.
Just one last point, because I'm in a arguing mode, but what people forget, I think, is that you're right. I do believe interest rates. Kyle, you brought it up because that's the playbook, and Jay, you just brought it up where interest rates will go back down, and that's good for business. But I think people forget that the reason why interest rates are going to go down is because all hell's going to break loose. So it's not going to be like, oh, this beautiful soft landing where, hey, everything's perfect, and now we're going to reduce.
Not necessarily, though. The Fed's even said that their plan is to reduce rates eventually. Like they're in restrictive territory right now, and once they see inflation come down to their 2% target, which let's be honest, it's somewhere between 2 and 2.5. They'd be happy with 2.5. They can bring their rates down so they're no longer restrictive. They've already said they're going to lower them.
Yeah, I don't pay too much attention to what the Fed says. I mean, if you look at the last time they tried to raise interest rate, as soon as the what hit the fan, they reduced that interest rate down to zero like within a week. Like they went from 0 to half to 1. They got it to what was it, Jay, 2 3/4 or something, whatever that number was. And then as soon as panic in the market and the stock market crashing, they had an emergency meeting and cut that thing down to 1 and then down to 0. So to me, that's what's going to cause the pivot. The pivot isn't going to be, everything was a masterly, a great landing, a soft landing. We're brilliant central planners. The reduction is going to be because the market, the economy and the stock market is going to be in trouble. And that's what's going to cause the Fed to reverse course. And that's not going to be good for business, at least not in the short term. It's going to help them because they're bleeding to death and they're going to come up with zero interest rates. But I'm not even sure that's good enough either. It's going to be, I think it's going to be sort of CARES 2.0 again. And it's going to be when the federal government starts printing more money that things are going to get better.
Yeah, I agree with Mauricio on this one because, I mean, if you look historically, a typical rate cycle, when we hit a recession, historically, and again, it wasn't like this necessarily the last 10 years, but historically, when you hit a recession and the Fed starts to lower rates, they lower 4 to 5%, so 400 to 500 basis points. And so to have a running interest rate, federal funds rate at under 5%, it puts you in really scary territory. Because if you have a bad recession and you need to lower rates and you can't get down to that historic 4 or 5% drop that it may take to really get things moving again, you don't have any runway. And
you print money.
But it's interesting. If you go back to the 2000, I guess it was 2020, the Fed went down to zero. They announced all kind of these liquidity and facility programs, and it still didn't work. it wasn't until Congress passed the CARES Act where they were going to just basically, not they weren't going to print, but they were going to the Fed was going to be able to print those dollars for the government. But it wasn't until the CARES Act got announced that some emergency action from the government that the markets actually calmed down. So it's going to be interesting this time around is when the Fed actually does pivot, goes down to zero, announces all this stuff, and it doesn't happen again. Is there going to be a CARES Act 2.0 or 3.0 or 4.0? And is that going to be sufficient? It just gets worse every time it happens. The cycle just gets worse and worse and worse.
I mean, no one really talks about the whole quantitative easing and quantitative tightening. So like right now they're still quantitative tightening, but for how long? They kind of just started it, and the first sign of any kind of issues, they're probably going to turn that off too. But if we start printing money again, then we're going to see a run up in things like crypto, which has been back in the news significantly. Kind of came out of the blue, but a New York judge ruled against the SEC. SEC's had a great track record in court lately, but they finally took an L here in the case versus Ripple on whether or not trading their XRP token is a security. Personally, I wasn't really paying attention to this case in particular. I thought maybe the big case would be the SEC versus Coinbase, because Coinbase is a much bigger kind of conglomerate. But the SEC has kind of had a bit of a vendetta against crypto since the whole FTX debacle. So, Mauricio, is this a big a deal as the media is making it out to be right now?
Well, obviously I'm an SEC attorney, so I'm interested in this topic from the SEC perspective, but I'm actually pretty surprised of the reaction from the media and everything. I mean, what you just mentioned, hey, this SEC took an L. That's not what happened, right? I mean, I've been talking since the end of last year. I did my 2023 predictions, and I did actually predicted that Ripple would be considered a security. And that's actually what happened. I mean, people aren't actually looking under the headline. The headline says, Ripple won, SEC lost, this is great for crypto. But at the end of the day, the judge, the Judge Torres, I think it was, in the Southern District of New York, basically said that if you're a cryptocurrency, you start a program and raise capital from investors, just like we do in the syndication world. When AJ, Kyle, you guys, Jay, raise money, when that happens, that's going to be a security. That's what the judge said. Now, Ripple's got it's a real business, by the way. For those of you who aren't up to speed, Ripple is basically like a Western Union. They allow people to transfer money internationally. They do it much faster, much cheaper. So it's kind of a competitor Western Union. It's been pretty popular. And what the SEC is arguing is that these tokens that they create to facilitate these payments, they're a security. And what the judge ended up saying, just to be clear, is that she ended up dividing these tokens into three categories, right? Category one was when Ripple issued these tokens to investors, right? They had sophisticated investors, just like the syndication world. They prepared marketing materials. They had memorandums. They basically pitched this thing as an investment and sold it to institutional investors, hedge funds, venture capital funds, whatever. And the judge said those are securities. Those sales to those institutional investors are considered securities. And those were about $730 million, about a third, or really actually technically a half of the issuances of these tokens were done to institutional investors. Those are securities. That's number one. Then what the judge said is then there's all these other securities. It's another 700 and change of securities of XRP tokens. They were actually traded on these exchanges, right? So the buyers of these tokens didn't really know who they were buying it from. Were they buying it from other people like you and me? Were they buying it from Ripple themselves? They didn't really have an expectation that Ripple was responsible for this token being successful. The judge said that's not a security. And then the third category was Ripple decided to use its token to pay its employees and to make other transactions, and that to me makes sense, is not a security. But it's very interesting because the judge essentially created this new law, literally out of the blue, which said, look, depending on the level of sophistication of the investor, we're going to categorize this thing differently, whether it's a security or not. And I would be shocked if the SEC doesn't. I'm actually shocked that they haven't already announced that they're going to appeal it, but I fully expect them to appeal this because what the judge is basically saying is that if you're an institutional investor like a hedge fund, you need the protections offered by the securities laws. But if you're like a mom and pop investor who is buying these tokens on these exchanges, then you don't need the protection, which is completely the flip side of what the SEC is really doing.
Didn't this entire case though just hinge on the Howey test? Like, isn't that what it all was?
That's exactly right. And we talk about, my layman's definition. I always talk about when I speak. I say, look, if if you raise money from passive investors where the returns are generated by your efforts,
or the expectation of returns, I think is the big word. Yeah.
that's a security. With institutional investors, the judge said, yeah, they were directly, communicating with these investors. So there was an expectation of a return from the efforts of Ripple. But somehow the judge decided that if you're buying these tokens on an exchange, you're not expecting the profit or the increase in value of these tokens to come from Ripple. It's going to come from something else, I guess. I'm not quite sure. But yeah, the same definition that you and I use when we analyze your guys' deal and whether you're your self-storage or your multifamily, if that's a securities offering, the same analysis happens here on the tokens. And like I said, if you're going to start your own protocol and issue tokens and you're going to sell that to investors, that's a security. That's what the judge said. It's only if you went straight to a exchange that the judge said that's not a security. So that actually helps. You mentioned Coinbase and Gemini and all these crypto exchanges right now have already announced that based on this ruling, they're going to start allowing XRP, which is Ripple's token, to be traded on their exchanges because based on the judge's ruling, that scenario does not involve a security. What I'm not clear on, which, I'm not super into the crypto world, but I would suspect that a company that's trying to raise money for its program will initially go to investors, right? Sophisticated investors to raise capital. And the judge was very explicit. That is a security because you are raising money from private investors where there's an expectation of return and the returns are generated by the efforts of the promoter. So I just think the headlines are misguided and they keep saying it's a loss for the SEC, Ripple, crypto and everything, when at the end of the day, at best, it was a split decision. And again, we're talking about a judge in the second, in the Southern District of New York. This will get appealed to the Second Circuit. And even if the Second Circuit applies, remember from a legal standpoint, we have 11 circuits in the United States. So even if the Second Circuit says, this is not a security, if there's a case brought in Silicon Valley, for example, and this in front of, the district here in the Ninth Circuit, that's not precedent. So they can, obviously it's persuasive. The Second District said XYZ, but in different jurisdictions, they can come up with their own conclusion. So this is definitely not a clear win or a clear loss. There's been a lot of people saying it's still, a little bit gray. It's even, created more mud than clarity. But but my point is, and I'll let you guys talk about this in a second. My big point is, I'm just surprised that everybody keeps talking about this is a huge win for crypto. It's a huge win for Ripple. It's a big L for SEC. When that's not really what happened.
I kind of disagree. And the reason I disagree is it depends on the premise. So I'm going off the premise that there's kind of this, underground belief that Gensler and Elizabeth Warren and all these people are basically trying to kill crypto and that they don't want crypto to be accessible to the common person. They don't want people just willy-nilly trading it and they want to get rid of it. And yes, there were different levels of this this ruling, but I think the level that matters is that you can still trade it on public exchanges. Any crypto or not, like in this case, it's the XRP, but it's still legal to trade it. It's not a security, and so that's where I think the big L comes. Is if you go based on the premise that the SEC was trying to snuff out crypto, then this basically sets the precedent that they can't do it.
Yeah, but all these other cryptos started with them starting their own company, their own protocol, their own platform, whatever they did, and they issued securities to investors. So all the cryptocurrencies that already have issued those tokens at the beginning to investors, those are securities. They have unregistered securities offerings, and then moving forward.
But we could still trade them now, though. They're already there.
Yeah, but look, Ripple's still on the hook for $700 million. They still have $700 million of unregistered securities they're going to have to deal with at trial. So they're probably going to get fined and they're going to have issues with those $700 million.
But I can still go out and I could take my XRP token and I could trade it to Jay and I could do all these things. So this is as a ruling, this is saying, hey, I can do whatever I want with my tokens and my money, and it's not considered a securities violation.
You can as a consumer, sure, but if you're trying to raise money, this is what these guys do. They raise money. That's what this whole initial coin offerings were. They're trying to raise money for their protocol. But if you try and raise money by trying to get investors to actually invest in your crypto in exchange for tokens, that's going to be a security, and you're going to have to either register, find an exemption, or it's going to be illegal because it's a security.
I think maybe Kyle, what you're missing, and maybe you're not missing anything, but I think the thing that I saw, because I invested through a crypto syndication, it was at the time probably one of the largest crypto syndications in the world. Bunch of my friends from Facebook and Google put together one starting like 2016 or 17. I kind of weaseled my way in. But over the course of 3 years, we probably invested probably close to 100 million in these initial coin offerings. Basically, the way it worked was it was very similar to what we're doing in the real estate world, where a company would announce they're going to release something in 12 months, 18 months, 24 months. And they'd basically say, we expect to release this coin. This coin's going to come out at 30 cents, we expect. We'll let you guys buy it now at 20 cents. And so give us a $5 million, $10 million now, and then you'll get a 50% discount on the coin when it comes out for that same value next year. And I remember at the time thinking, this is crazy that like literally we're doing the same thing that angel investors or venture capital investors are doing to invest in tech businesses. And yet we didn't have to register. We didn't have to prove we were accredited. We weren't signing
like a white paper. You had, what did you get, Jay? Like a 3-page or 10-page little piece of paper, right? That just explained what the deal was.
It's literally what we got was a white paper. And there was a contract. I mean, we did have a contract.
A subscription agreement. Say that.
It was a subscription agreement. It wasn't a PPM. There were no disclosures. It was at your own risk, and we were all accredited. But I have to imagine that's probably not true. We may have had people in the group that weren't accredited. And so, what, Mauricio? I guess my question for you is: so let's say I participated in 20 or 30 of these back between 2017 and 2019. At some point, the coins were released. People were given the coins. They sold them off on exchanges or whatever. Is there any liability for all these companies that were doing this 5 years ago that at this point really don't have that relationship with investors, but they were doing this years ago?
Yeah. So what this judge is saying is that if you purchase these tokens directly from the company, which is what you're describing, like our regular syndication, then that is a security, and they needed to either register that security, which they obviously didn't, or they need to find an exemption, right? And so the question is, what's the exemption? Now, if there's non-accredited investors, as you pointed out, then it's really tough because the only exemption you really have is 506B, right? It's the same rules that we apply in the commercial real estate world. It's a 506B, but then you can't advertise, and I'm pretty sure these guys were all advertising. So then you have to rely, if they're all accredited, then maybe you could argue, look, yeah, we didn't follow Form D, but look, this is a 506C. They were all accredited investors. We're all good, and we're not required to provide them with any disclosures. The disclosures we did give them, the white paper that you got, it wasn't misleading, and it had all the information. There might be an argument there that there was an exemption, whether it's a 506C or a 482 or whatever the exemption is. But my point is, the same rules apply. You have to register the security, find an exemption, or it's illegal. Specifically when, like in your case, you're selling directly to the public, which is what all these ICOs, these initial coin offerings were. Now, once Jay got his coins and decided to put them on Coinbase or whatever and trade them, and then Mauricio bought it from Jay, that's what the judge is saying. Well, at that point, it's not a security because
which is all that anyone cares about right now. That's why it's all in the news, is because the average consumer didn't get the XRP token straight from Ripple. They went on to they went on to Coinbase, or they went somewhere else, and they bought their token from there. And the scuttlebutt was like, everyone's worried that it's going to be illegal for us to trade crypto amongst each other. Like, it's going to, in the US, we're not going to be able to.
It's never going to be. No, it's never illegal for you to own it. I mean, in fact, it actually hurts you. Again, this is where the headlines. I mean, I would argue that
they were saying it was going to be illegal to trade it. That was the thing. Is that's where we're going to. That currently, before this, the only non-security token was Bitcoin. Every other one was kind of in that, okay, like it could be considered a security. And so everyone was saying, if these are securities,
but that's not a concern for you, though.
It would be if I want to trade. If I had a crap ton of Dogecoin, and all of a sudden it was considered, I can't trade that on a public market. That's what everyone was worried about.
You don't have an obligation to register the security, find an exemption. It's illegal. But
I won't be able to trade it, though. That's the thing. If she came back with that ruling and said, on public markets, it's still considered security, then all of a sudden we wouldn't be able to trade our Dogecoin. And that's what everyone was worried about, that's what the US is trying to do. That's what, at the behest of Gensler is working with political motivation, that he's trying to get rid of it because the U.S. is trying to do this central bank currency and yada, yada, yada. That's what everyone was worried about. And so that's why everyone cares about this and is saying it's an L for the SEC, is because that basically snuffed out the whole idea that once I own a token, I'm in the US, I can trade it wherever I want. We don't have to have these companies who are running the exchanges go to Singapore so that I can actually trade these tokens that I bought fair and square.
Fair enough. But it still means that the 1,000 cryptocurrencies that currently exist raised capital initially illegally or unregistered securities, and then moving forward, any new cryptocurrency that wants to come up is going to have to register or find an exemption on the future security. But you're right. To the extent that you personally were concerned, this helps because, like I mentioned earlier, it helps the exchange. It helps Coinbase, Gemini, all these, which in fact they've already come out and said they're going to start allowing. Look, I wanted to buy XRP and I couldn't find. I know there were a couple places you could buy it, but now I'm going to be able to go into my Coinbase account and buy it.
Talk about a flex, eh? Coinbase is getting sued by the SEC, and the moment it comes, the moment that it drops that XRP, the ruling, all of a sudden Coinbase is, we're going to put XRP on our.
They should again, but let's remember. So this was a motion for summary judgment. The judge ruled like a split decision. Some of it was a security, some was not. This is going to get appealed to the second circuit, which is the New York circuit, the top right part of the U.S. and. Eventually it's going to have to go to the Supreme Court, because I'm pretty sure the Ninth Circuit, for example, is going to take a different position than the Second Circuit. So now you're going to have two different circuits. Texas is a separate circuit. Florida is a separate circuit. We have 11 different circuits. And typically what happens is that ultimately will reach the Supreme Court. But that's going to take 3 or 4 years.
I know AJ has comments politically here, so I'd love to hear your insight in this.
Don't know about politically, but Gensler is he's a banker. He's not an attorney. So when he came in, he issued 33 proposed rules specifically going after cryptocurrencies. And he was Goldman Sachs.
Yep.
He was up, and it was a partner at Goldman Sachs. He came in, he immediately shoots after a few different industries, but the dude's on a mission, right? And the problem is, though, he's taking L's, and out of those 23, he's going to take way more. So they're already being challenged in court. And a lot of people are like, this is a crusader that's just going out and attacking these different things that he's trying to get done. And a lot of these, in fact, probably most of them are going to be challenged and struck down. And I think it's a really interesting era that the SEC is in, where you bring in this partner from Goldman Sachs to the SEC, and he immediately starts going after competition, right? And you can even look and see all of his proposed changes, where he was going after. But it doesn't, to me, it doesn't feel like the SEC is actually hitting any of the meaningful problems. It's he's going after either these side things or these missions that is a stretch. They're not slam dunks. It doesn't seem like there's even really a uniform mission here that Gensler's trying to do or accomplish. And I think it's eroding a lot of faith, where it's a lot of people are stirred up about this, where they're like, this shouldn't be going in. He shouldn't have gotten this. It is, I think so. I think it's more than an L against the SEC. And I think that if that continues, it's going to look bad on him. And it's going to look bad on Gensler when it's like, what are you doing? You're going after more Main Street stuff, right? And he's going after, different things that had to do with Main Street players, not because they were hurt, not because they were systematically went against. And I just think that looks really bad. And I think it's painting Gensler in maybe not a light that you want the head of the SEC painted under. And you want the kind of confidence that the SEC is actually looking over bad players in the marketplace. But instead it's just another banker. And it just rubs me wrong.
But AJ, remember, and I agree with you, but I mean, remember that Gensler is a part of the government, right? And governments do not want cryptocurrencies. I'm actually surprised. This is, when I started following crypto, my biggest thing about crypto was there's no way the US government, let alone the rest of the world, is going to just give up their ability to print money out of thin air and control the currency by handing this over to Bitcoin and other cryptocurrencies, right? And I've actually been surprised that the one cryptocurrency that's really there that potentially could unseat, the dollar as the sort of global reserve currency, which is Bitcoin. That's the only one that's actually been said, hey, this is not a security. This is actually a commodity, and it's actually fine. And to your point, they're going after these minor ones, but the Gensler just represents the government, right? And the government, and I'm not just talking about this particular administration, I'm talking about the US in general, all these world governments, they don't want competition. Why would they want competition? I'm surprised, honestly, it's taken this long for them to squash it. I mean, I fully expected people to say, look, it's illegal to trade crypto. Like literally Congress would pass a law that said it's illegal to own crypto. Crypto is going to be taxed at 80%, whatever it takes to make sure that crypto doesn't even begin to potentially replace the U.S. as
I think that's the problem right there, though, is politically nothing's going to get through Congress right now. Like the thing that's happened, it's become political, whereas it wasn't really before. It's become this, okay, Democrats are anti-crypto, and because you have people like Elizabeth Warren who's spearheading this campaign, well, like Republicans love to just shit on anything that Elizabeth Warren does. So when she does something, then they're going to come out and kind of be against it. And so as long as we have like a split Congress, then I feel like it's dead on arrival. Nothing's going to get passed for a year and a half. Now that could change. We could in a year and a half, we could see a change. And that could even be a platform that we see Republicans run on, that we already saw DeSantis come out and say, if he was elected president, he would basically make it illegal to have a central bank digital currency. I feel like that's a step in that direction of running on this platform. So I think this might just become a political thing that it gets all wrapped into that.
They're stuck in a hard place because this is the same thing with Gensler going after AI. And the thing that they're walking, this very fine line that they're walking. Okay, we need to keep it under control. But the one thing they can't do is be the country that got left behind in blockchain, crypto, and AI. So they're in this mode where they're like, we need the private sector to innovate it, and then we can control it and take it over. And it's this just fine line. And how do we build this up? How do we let the infrastructure get there? How does the world adopt it? How do we get it to a point where it doesn't get out of our control? Right? So they're walking this fine line. So how do we get it to a point where innovation is good? They're building these things out. The United States, now we can use AI to go out and put it in the military complex and go get us some oil. And, how do we go out and, make this really work to our advantage, where crypto is doing good and Pocahontas is happy with it. They're all, it's just this line where they're all working here.
I don't think we're going to go down the start pulling the AI thread. So let's try and bring this back. It is called drunk real estate. So let's try and bring this back to a little bit of real estate. But I'll come back at you, AJ, because the Fed rate seems like it's pretty close to its peak. So the question is, if the Fed rate's at its peak, then does that mean commercial real estates are at a bottom? We've spent years underwriting cap rates that will go up every year for when we exit. But do you think over the next couple of years, the next year or so, we're actually going to see cap rates go any higher, or do you think we're going to see them going down?
So I think cap rates is a funny conversation. And I think we got to preface this, for a lot of people that maybe don't understand exactly what a cap rate is, why they go up and down. When you're looking at real estate, we essentially have two different components of value. You have what I look at as intrinsic and extrinsic value. Intrinsic has to do with the plain and simple, the revenue, expenses, net profit. Extrinsic has to do with market conditions that place a price for that asset to be traded. Okay. Those are the two different things. A cap rate is an expression of the return. If I have $1 million property that I buy and it's going to make me $100,000, that would be a 10 cap, i.e. a 10% return, not including debt. Cap rates are a reflection of market demand, meaning that what investors are willing to pay for those assets. Really nothing more. So if you have and because of that, you have some assets that cap rates will rise with interest rates. Why? Because money costs more, so less investors can buy assets. There's less investors, so you need to have a higher return to entice those investors to come in. While other assets may not have a cap rate rise, even though interest rates are rising, because there's enough investors to keep buying them and demand for those assets are still high. So matured assets generally have a range in which they fall of cap rate cycles that we can see. That there's always kind of.
Can I jump in for one? So just to say this in another way.
Oh my God, Jay, you're so rude.
I'm sorry.
You're like in the middle of his whole thing, you like disrupt him, just totally interrupt. But go ahead, JJ. Go ahead.
When you're talking about rude, you're over there snacking. We can hear you snacking on your mic.
It's like dinner time over here, and I'm hungry and I'm eating.
I like to think about a cap rate as just a multiplier. So
it's a PE ratio.
Yeah, but I mean, for people out there that don't know PE ratios and don't know all the complicated stuff, it's a multiplier. And so if you have a certain type of property in a certain market, let's say you have a self-storage property in Philadelphia, Pennsylvania, it's probably going to be worth some multiple of whatever income it's bringing in. You have a multifamily property in some part of Houston, it's going to probably be worth a different multiple of the income that it brings in. And the cap rate's just an expression of what that multiple is for that type of property in that particular market.
Risk adjustment.
Risk adjustment. Yeah.
And when you look at cap rates, they trade at normally within an asset class within a certain range that follows, like poor assets and poor markets will be a higher cap rate because they need to offer more to entice investors in, and more stable markets that are more class A, nicer assets, they don't need to have as high as cap rates. They can have lower cap rates because you have more buyers that want to purchase them. That is a general rule of thumb. Now, when we look at the averages, it shows a lot about market sentiment, and it shows a lot about capital allocation within the markets. And interest rates plays a big, big role because it is the main tool for real estate. That's leverage. And so it directly correlates what one can afford. Even though cap rate calculations do not take in interest rates to the equation, the investors do. So we've seen really, when you look at kind of where we're sitting now overall with cap rates in a lot of the sectors have gone way up with interest rates. So if you look at retail, office, multifamily, they on average across the United States are up to or past what they were in 2013 and 12. And so on average across the board, interest rates have hit those really hard. Now, the exception to that is industrial and self-storage, which are still under where they were trading then. And that is simply due because there's more investor overall demand for them. And now, when you look at where the cap rates are headed, the general consensus right now is that cap rates will lower over the next 2 years because that consensus follows interest rates, right? So interest rates will calm down. Investors will come back into the market because they expect those assets to perform. And that spread between your debt and your cap rate will become favorable because as of right now, it's inverted, right? So if you look and say, all right, I'm going to buy a multi-family property for a 5 cap, and you have a 7% interest rate, that spread doesn't work, right? Now, when you have interest at 2%, well, a 5 cap works. So that inverted nature, right, of the cap rates is what is really driving that spread and that push, which as interest rates cool down and it goes back, it makes it more palpable and people can get in, they can buy more, investor demand goes up more, capital's flowing, and cap rates will go down, which means values. So values will go up as cap rates go down.
Is that true though, AJ? Is that true in a recession though? Because again, my thesis my base case right now is that the reason why interest rates will go down is because we're going to have some major financial difficulties. So even though the interest rates will be going down, if we're in a major recession, we have 10% unemployment, doesn't that affect the equation as well?
So if you look at cap rates through 2008 and 10, they still did not go to where they were in 2004 to 2000. So cap rate across all sectors went from 5 to just about 6.5 or just above through 2008 to 2012. Well, previously at 2004 to 2000, they were right about 8 caps.
Well, and the problem then was the debt too, right? Like it wasn't necessarily demand that was driving it. It was that people literally couldn't get loans. No one was issuing loans at that time. So even if you wanted to buy self-storage at a 6 cap, you couldn't because you couldn't get a loan on it.
Bingo. And so then from that point, they've only gone down, and they've followed, like Kyle just mentioned, not just the interest rate, but the ease of capital. So the more people that could actually get capital, the more buyers there became, and the more competitive it drove down. Now, we've been at historic lows, obviously, in cap rates across all sectors due to the ease of money and the cost of money. Investor demand was massive for real estate. Real estate generally is a hedge against inflation. So there has been a lot of demand. But as interest rates went up so fast, that starts to cause major, major turmoil in the real estate markets, definitely outpacing inflation with that, because those interest rates just jumped. And that creates problems when people refinance. That creates all of a sudden your exit strategy, your assumptions in your underwriting, right? Like it jolts the real estate market, where you have all these money managers, asset managers, sellers, everybody are trying to redefine expectations and capital allocation. And now they're also wondering about performance. So now that puts into question, if we do go into a recession, how will performance look? And generally speaking,
when we go into recession,
when we go into a recession, yeah. Was how
market's calling soft landing right now. If you look at it,
that's why we're now officially going to a recession, because now people are starting to call it soft landing.
Exactly. So moving forward, they think it's going to be a general move down. They do not, the consensus is they do not think that it will go down to on average back. Now, there's one thing we got to really state, that this is. We're talking about averages, but this depends on location, properties. When we got in a spot like we were the last 3 years, cap rates did not follow value anymore. So you could buy an asset in a town in Texas that had 30,000 people for the same cap rate that you were buying something in Southern California. That doesn't make sense. It's not logical in investing, because they shouldn't do that. Right? It should be some correlation that you're getting a, class B or class C property. You shouldn't be paying the same cap rate right as that. That had to do with such easy money being out there. And today we're seeing a lot larger spreads from markets and quality of assets that didn't exist for quite a few years. I mean, you're talking 4 or 5 years previously, people were snatching up dogs and paying premiums for them. And that has generally gone away. So the spread in bid and ask in the market has been exaggerated now, which that's good. That's natural. That should be. And that goes away with that cheap money. Well, I think that as cap rates go back down in a lot of these asset classes to something more of a norm, I think generally that spread's going to stick.
What do you think? What do you think norm is?
Well, it depends on which asset class you're talking about. So, like industrial and storage are still below norm. They have not retreated to anything they've ever seen previously. But multifamily, if you're looking at multifamily is up at, like a 5, and from 2021 to all the way back to 2012, it was under a 5 cap. And I mean, you guys are in multifamily. You tell me what you're seeing out there, but multifamily is probably the safest real estate asset class to be in. I mean, that's just I don't. It's
Just because, well, we talk about because of loans, right? It doesn't matter. The entire world blows up. COVID happened. No one was lending except Fannie and Freddie.
Yeah.
We got a loan in, what was it, Jay? March 2020,
Yep.
like literally right after COVID from Freddie Mac. Like it doesn't matter. The everybody needs a place to live. So we're always going to have that one lender backstop.
I think I don't want to speak for other asset classes, but certainly in multifamily, I think over the last 6 to 12 months, we've also had this big price discovery problem. Basically, we can't figure out where cap rates are. So we can talk about where normal cap rates are. We can talk about where they were 2 years ago. We can talk about where we think they're going. But right now, we don't know for the most part where cap rates are. I mean, Kyle and I and our team, we took a couple properties to some brokers we know about 6 months ago, less than that, 3 months ago, and basically said, shop these properties with your buyers. We want to get an idea of what they would pay for them. And all the buyers got the same information. They knew exactly how much money we were making. They knew exactly what our expenses were. They knew exactly what our margins were. But they came back with vastly different prices or offers for our properties because nobody in the market knows exactly what the cap rate, what that multiplier is. And some of them were applying a smaller multiplier. Some of them were applying a larger multiplier. And we were seeing buyers or other operators that were valuing our properties at vastly different market values. And so nobody knows because, and I would suggest that it's because there's so little transaction volume right now. There's so few properties transacting that nobody really knows where the market is right now in terms of cap rates. And so,
Jay, isn't that human? Like isn't that human nature though? I mean, I'm gonna try and make this argument with a bottle of wine already in, but I mean, isn't that what happens every time where when markets turn and the prices start going down, which means cap rates are going up?
Yep.
Aren't the sellers a little bit more reluctant to recognize the reality of the situation where they say, hey, properties have gone down. The buyer's like, dude, your property is 20% lower. Like, no, it's only 15% lower.
Yeah, but I think what Jay's saying is the uncertainty, though, is what's getting us. The thing is that we can get deals done in low interest rates. We can get deals done in high interest rates. We just got to know what they are. And the thing that we've been going through in the last year is we didn't know where interest rates were going. We didn't know what the rules are. We didn't know who was lending. There was time we would go a week where it'd be like, okay, all these bridge lenders are back. We're going to be able to, get all these. And then all of a sudden they're gone again the next week. So the thing is we don't know how to underwrite.
But that happened the same thing happens like in 08, 09. It's when you have that inflection point where properties have been going through the roof, cap rates are being compressed for years and years and years. And then there's that inflection point where you reach the peak. Now it starts to come down. I mean, I remember I was in the market. I was a lonely associate working at a law firm back in 08, 09. And I was looking for a condo to buy. And people are like, oh, yeah, this condo is worth X. And I'm like, no, the market's down 20%. There's just a lag effect where the sellers are reluctant to realize that their price of their loved property has gone down sufficiently, and they hold on as much as they can, and then the property goes down even further. There's a lagging effect.
I'm not talking about the supply side. I'm not talking about sellers. I'm talking about the demand side, buyers. Like 2 years ago,
the buyer thinks the property is worth way less than what the seller thinks it's worth, and there's a lag.
No, that's not what I'm saying. I'm saying 2 years ago, I could take a property to market and I get an offer for 34 million, and then an offer for 36 million.
You would have best and finals where they were all within 600,000 of each other.
Because you hadn't you were at that because there was no surprise from the inflection point. The problem is you have an inflection point where you've hit the peak of the market. The market is now down 20% or whatever the number is in your particular market, and the sellers are reluctant to admit that the property has gone down, whatever it's gone down in that particular market.
No, I think you're missing my point. Again, two years ago, I could take a property to market and I get an offer at 34 and 36 and maybe a couple in between. Now I take that same property to market and I might be getting an offer at 28 and 38 and a bunch of stuff in between. And so that spread is much different. The buyers can't figure out what a property is worth. The buyers don't know what the multiplier or the cap rate is in the market. There's no consensus on what the cap rate is in the market.
But you don't think that's a change because when the market's going up, there's a consistent delta of what the price was last year versus what the price was this year versus the price 2 years ago. But when you hit that inflection point, don't you think that makes a huge that's what causes the unknown, is that there's not an inflection point. So, everybody talks about this knife falling. Don't catch a falling knife. Well, how low is that knife falling? Isn't there just a discrepancy?
I'll put it this way, Mauricio. So like when you're underwriting a loan for a construction loan, let's say, so you're building a multifamily property, you're going to put in, okay, what is current SOFR rate at? What is the delta above SOFR that you have to pay? And then you're going to put in a little bit of a margin on top of that for fluctuations. Right now, that margin that people are putting in, people are just guessing. Because we, for the last year, we're like, okay, is the Fed hiking to 7? Are they hiking to 8? Are they going to stop at 5? We had no idea. So not only us, but the banks at the same time, all these bridge lenders, all these non-Fannie Freddie lenders, they're putting in their own margins on top of that as well. So we basically, 1 week to the next, we had no idea what we were getting for debt. We had no idea if it's a stabilized and we can go right to Fannie or Freddie. It's a little bit like more normalized what the pricing is. But if you needed anything other than that, like you didn't know what kind of debt you were going to have a month from now when you're actually having to lock in this loan. So people were having their own, to Jay's point, delta on the multiple for that risk of the uncertainty.
So I think, and one of the things that I want to talk about, or I kind of want to really even just wrap up the cap rate idea. I think a lot of people look at this, it gives us a good feel of the overall market sentiment. But Mauricio, what do you think the average cap rate of the last 10 deals that I bought was?
I have absolutely no idea.
Yeah, but you're off market though, right, AJ?
Me neither. Yeah, I don't know. I couldn't tell you what the cap rate of one.
But you do all off market stuff though.
Yeah, we do lots of. We bought last 10 deals. We bought some stuff on market, but when you look at this extrinsic versus intrinsic value, mine is so predicated only on more of that intrinsic layout and that revenue and how we can get that revenue up, right? Because cap rates, especially for storage, it's like, okay, well, we have a 20% expense ratio. No, you don't. And no bank's going to agree that you do. So your 5 cap at a 20% expense ratio is actually a 3 cap, which it's not. And we don't agree with that, right? So there gets to be a lot of muddling with a lot of this stuff. And I think that although cap rates may show that they're, either going up and down and quality is correlated with cap rate, that's actually not true, especially in the market today. So we're actually underperforming assets are going for lower cap rates or higher value. And that's not supposed to happen according to textbooks.
Well, you pay for the value add though.
You pay for the value add, so because there's upside, so there's run up. So that actually has high investor demand, where today those really expensive, nice properties, you have to buy the value. So now I have to get a higher cap rate because I don't know what revenues will do over the next year. But I'll tell you what, they're not going to go up. We're not going to get 10+% increase on rates. So we know that's not happening. So if I don't think that there's going to be a lift up in the rates and the occupancy, then I'm only getting my value when I buy. So then all of a sudden now you have like this inverse effect where an underperforming asset I'll actually pay more for, get a lower cap rate, not. So I think people shouldn't hold too strong to cap rates.
But you still need to know.
You got to know what it is and know what's happening. Yeah.
For exit, right? The whole big thing that we're getting into right now is we're pro-forming, and absolutely every single business model that anyone's ever made in commercial real estate has been wrong. Sometimes it's wrong high, sometimes it's wrong low, but it's always wrong. But the question is, whenever we pro forma, whether 3 years, 5 years, 10 years out, we have to put some cap rate on there of what we project the cap rate is in order to project returns. And it's been relatively easy up until this point because we just said, hey, we're buying this for a 4.5 cap. That's what the market rate is. It's a 4.5 cap rate right now. We are going to be conservative and we're going to say, okay, 5 years from now, we think cap rates could be up to 5%. So we're going to pro forma, the market getting worse, and we're going to exit at a 5% cap rate. My issue right now is how do we pro forma that exit? Like, what numbers do we use for that?
And Kyle, I don't know about you guys in your asset class. For us, banking standards and cap rates are usually always the same, meaning that if the market's giving if the market value extrinsic value of in the form of a cap rate says it's a 4 cap, right? The bank doesn't care about that. They're not going to say, yeah, we're going to finance this thing off a 4 cap. No, it's going to be a 6 cap. And then if the market's saying it's a 7 cap, generally the bank's going to put a 6 cap on it anyway. Like their cap rate that they're putting in their underwriting is way more standardized, I guess would be an easy way to look at that.
And they use DSCR too.
Yes. So when we look at that, for us, that value component, we're in the short term, anything out, we're really trying to predicate that on a refi, or we just basically match what we think the banking standards is.
But even a refi, you need a cap rate for a refi. Like you need to peg a value at that capital event. And I don't know, like to bring this back to the original discussion, maybe we'll go around the horn and say, where do we think cap rates are going and how quickly? I'll start, Jay. What do you like? Where do you think cap rates are headed, and in what time frame?
So I think last summer we saw a big expansion in cap rates. We saw a big drop in values last summer, 20 to 25% across a lot of the markets that I pay attention to. I don't think we've seen a lot of movement in the last year. That it was crazy. It was like a big drop, and then I think things kind of settled out, and they've been there for the last year. I think we're probably near a low in terms of values, not cap rates, near a high in terms of cap rates. Maybe there's a little bit more room to drop, but not much. And I expect that for a couple of reasons, we're going to see cap rates start to drop over the next year. But the two biggest being, one, this isn't going to be a typical recession, in that a typical recession, everybody gets hit, everybody starts losing money, everybody's struggling. What we've seen since COVID and especially over the last year or two is this increase in the wealth gap. And there are a lot of people with a whole lot of money and a lot of people without a lot of money. And I have a feeling this upcoming recession is going to impact the people on the lower end of the spectrum a whole lot more than the people on the higher end of the spectrum. And I think even through this next recession, there's going to be a lot of capital looking to be placed. And I think there are a lot of investors sitting on the sideline right now. And once we start to see the market softening and people start to feel like, okay, they're comfortable saying that we're at a bottom in prices, there's going to be a lot of capital that flows into the real estate markets. And I think that's going to drive demand, and that's going to drive cap rates down.
What's your time frame?
I think 24 months, we're going to see at least a return to halfway between where we are now and where we were a year and a half ago. And I'd say in the next 24 to 36 months, we probably get pretty close to where we were a year and a half ago.
You think it's going to take that long?
I'm being conservative.
So that's 24 months. That's 2 to 3 years, Jay. We're talking about what's going on in the next 6 to 12 months.
I think in the next 6 to 12 months, we're going to see a bottom, and I think we're going to start to see cap rates come down and values start to go up. Well, whether it's going to be really quick, I don't think it's going to be really quick, because I think there's still going to be a volume issue. I think we're not going to see a ton of transactions for the next 6 to 12 months. And I think until transactions start to pick up, we're not going to see that price discovery. We're not going to see cap rates really be well defined where they are. But I think we're at a bottom. I think things are stable, and I think they'll start to slowly go up. And once we start to see a lot more transactions, I think cap rates will go down faster. Values will go up faster.
Mauricio, what do you think?
It's kind of a loaded question, because it's the same as somebody asked me, like, what do you think the real estate market is going to be? There's obviously no real estate market, right? There's different asset classes, there's different markets. There's so many different variables. But at the end of the day, I do think it's going to depend on, obviously, how severe the recession is. I mean, is it a mild recession that, whatever, or is it like a 2008, 2009, or is it worse? Because if you suddenly get unemployment that's huge, then all these class, C and class B multifamily, for example, are going to get hit a lot harder, and those cap rates are going to go way high versus, A class or even self-storage. So I think it all depends on the recession. I'm still believing that the recession is going to be much harsher than most people think. It's going to be closer to the 08, 09 type of recession, not worse. And so if that's the case, then I would argue that in general, cap rates are going to expand because real estate prices will go down.
You agree, AJ?
I think I think the major food groups in commercial bottom out, and then I think we've probably gotten close to bottomed out on values.
Except for office.
Yeah, except for office. Storage, I think, as well. I think storage cap rates will rise. It's been a lagger. And so because we've seen them go up in the last few months, where we just have people that are just late to the market, right? And now they're getting there. So I think at the end of the year, I think is going to be really telling, because we'll start to have owners in all asset classes say, all right, got to make a decision what we're going to do here. So I think we're going to get some good comps in the fourth quarter. But I think office, yeah, I don't like it all. But the other ones, yeah.
AJ, how did self-storage do in 08, 09 when the whole single-family market crashed and people lost their homes and all that's going on? How does self-storage do?
Well, self-storage and its cap rates during that time was not like you're talking about cap rates were all over the board. You couldn't get financing for it. It wasn't one of the major food groups yet, even still. So there wasn't a lot of people even out there trying to buy it. So cap rates were high.
Commercial real estate in general, though, went down about 20%.
But I remember reading, and again, I don't know, so that's why I was asking you, AJ. But I mean, if something dramatic like that happens, like another 08 or 09, people lose their homes, people downsize their homes, that generally creates a higher increase or a higher demand from a consumer standpoint for self-storage, because they used to live in a 3,000 square foot place. They couldn't afford it anymore. They lost a job. They had to sell their home, go rent an apartment. And they had all this extra stuff, and they had to put it in self-storage. That's the story I remember? Does that sound close?
Change is good for storage. We need change. The worst thing for storage is stagnation. We need change. So
a huge recession could potentially, specifically for the self-storage asset class, could be a boom if things go sideways for single family and apartments.
Yes. People moving around have to use storage.
Right.
I'm gonna go against you guys a little bit. You're right, though, Mauricio. If we do see some sort of major recession, then all bets are off. That's kind of one of those things. But assuming we have some sort of mild recession, or even, who knows, a soft landing. But assuming we have some sort of mild recession, I'm thinking we're in a year timeline at this point. It's one of those things, like we tested already how low cap rates can go. Now we kind of found out like what's crazy, and we can extrapolate from that. We tested the whole theory about cap rates and loan rates. Cap rates can never go below what the loan rate is. Well, we're doing it. It's happening. People have an appetite for it. So I think we're at a bottom here for multifamily in particular. I think we're at a bottom here. And I think we're on a year timeline where we see cap rates start to normalize here. We're getting a little stagnant. And then come 2024, we're going to see them tick back down. And instead of we're 5.25 cap rates, we're going to see mid fours.
Yeah, well, 2 points there, Kyle. First, don't give me any credit. I'm a bottle of wine in, so I'm not sure if I'm even making sense these days. And second of all, where did AJ go? I want to know where AJ went. He disappeared. I don't know where he went.
He just left. We didn't realize he had a hard cutoff at an hour and 50.
He texted that he had to.
He's got to go make dinner with his wife and kids. I mean, what's going on here?
He was the one who wanted this time. He wanted the earlier time. He
grabbed his backpack and he's gone. He's
changed
done.
this just for him. All right. Well, I think that's a cue for we should probably wrap this up and go on to our top 10. I'll try and make it fast. So we're talking about cap rates and how low cap rates could go. And there were 4 cities who got all the way down in multifamily to a 3 cap, borderline under a 3 cap. And then we had 5 other cities that got down to a 3.25. So I want you to throw it a couple and see if you can guess a couple on this list.
San Francisco.
Close, but no.
New York City.
No.
AJ, what do you think?
AJ's going to guess Boise, and he was right. Boise went down to 3%. Austin got to 3.25, but it's still not in the top 4 for those 3%.
North Carolina, city of Charlotte.
Charlotte. Nope. You guys you're not hitting the buzz one. So we got Nashville,
Miami,
Boise, Phoenix.
Miami.
We're all 3%. Miami's been kind of a recent development. If you're talking about, these are lows from back before the interest rate hikes. Los Angeles actually got down to 3, and then the other ones to round these out: Boston, Austin, Dallas, Denver, and Salt Lake City.
Was Los Angeles the city or the county? Because that's a big difference.
I don't know, Mauricio.
Who cares?
God, it's just you just had to give me shit about something on the top 10.
Did you know that if for all you sushi fans out there, there's a Uchiko, which is a huge restaurant and sushi restaurant. They're opening one in LA. Just FYI.
That's his plug for the night.
So, well, here that's a good. So let's roll that into a question. I had a couple queued up, but I have a good one then for that. So Jay actually for I forget what he got us for, but I think it was Ashley's birthday. He got us a gift card to like a really expensive restaurant near us, and we were using it the other day, and the topic came up between Ashley and I that can you use a gift card? Like if you were there on a date, could you use a gift card on a date? Or would you just have to pocket it and say, I'm going to use this some other time? So the question is, can you use a gift card on a first date?
How long has it been since you've been on a date?
On a first date? I've been married for 14 years, so 16.
Yeah. So,
Can I answer that as a pro?
Yeah.
What you want to do on a date is you want to handle the bill separately. You don't want to like wait till the waiter comes to your dad. You want to go to the bathroom, sneak out, give the guy the credit card. So in this case, you would give the credit card plus your, gift card. So by the time the meal's over, it's handled. It's taken care of. That's like
So your vote is you can do it as long as your date doesn't see it.
It's a pro. Yeah, it's a pro move. You're just talking about rookies. If you're a pro, it's no problem. If you're a rookie, maybe not.
I don't think we are qualified to answer this question. We're all old.
What's your opinion, Jay? Just give me your opinion. Give me your opinion. If you saw somebody, if your kid went out on a date, would you recommend them to use a gift card on the first date or not?
I keep reading all these stories of all the kids dating these days and 20-somethings dating these days. As they meet on Tinder and they go Dutch and they split the bill and one of them like walks out in the middle because the other one didn't look like their profile. And I didn't think people actually went on real dates anymore.
What's that have to do with the gift cards? Answer the question.
I'm traditional. No, I would never use it.
Let's ask AJ for his opinion. AJ, what do you think?
AJ, what do you think? Yeah, no. AJ doesn't want to comment on this one.
I would never use a gift card for a date. But again, I haven't gone on a first date. I've been married 15 years. I haven't gone on a first date in 5 years. 15 years, 17 years.
First of all, that's wrong. First of all, I've been married for almost 10 years. I go on a date with my wife regularly.
I said first date. I go on dates with your wife all the time, but not first date.
I think Mauricio missed that.
You got to keep dating your wife.
I will keep dating your wife.
I know you do. Hey, Jay, I know you do. I'm just telling the guys out there, you got to keep dating your wife.
or Mauricio's wife. Fair enough.
We haven't started plugins yet. We haven't plugged yet. Come on.
Let's go. Let's see who Mauricio wants to plug other than his wife tonight.
Are we plugging already?
Yep. Plug away.
I'm definitely not going to be plugging Ashley today. So I'm going to plug the Real Estate Syndicator Live podcast every Wednesday, 4:30 p.m. Pacific. And we do a live, and looking forward to seeing you guys next Wednesday.
Every time you say that, I think about it. We're doing it live. Okay, so Jay.
Okay, I have nothing to plug. So what I'm going to say is anybody that's gotten here an hour and 20 some minutes in, the first person on YouTube to put a comment that they heard this, I'm going to send them a copy of any one of my books that they want. I'll reach out to them, make sure there's a way I can get in touch with you, but post a comment in the YouTube that you got here, and hit the like and subscribe button or whatever you're supposed to say. Smash the subscribe button
and the notification. I love that. We should do that. We should do that more often.
Yeah, you got to be a subscriber, and you made it down here.
No, I agree. We should start. So from now on, we're going to start giving away stuff at the hour and 25-minute mark for you hardcore that stick around. We're going to start giving away free stuff. So I like that, Jay. Good move.
There you go. How about you, Kyle?
I'm going to plug my wife as I do every night. Badass Investor. Follow her on their socials. She's got a new YouTube thing going on where she does YouTube shorts, and she's pretty excited about it. Puts out some great content. So look up Badass Investor. She's smarter than Jay and much better looking. So I've actually had an empty drink for quite a while. I assume everybody here, Mauricio, needs to have something to eat. Jay probably has to hit the head. So we've switched this up. So guys, I will see you next Tuesday.
See ya.
See you next Tuesday.